What's up, YouTube? Welcome back to the Goofy Investing channel where we talk about investing into the stock market. This video is going to be about a stock or a company called Ouster. All right. We're quick disclosure: I do not hold a position in this company. This was a requested company for me to do a video and analysis on. I found out a lot about this company doing the research and due diligence. So hold on to your seatbelts because it might take a little while. This might be a little longer video. Okay. So Ouster is a lidar sensor company which is based out of San Francisco, California. They provide infrastructure and a combination of SaaS technology and hardware combined, and they produce sensors for traffic, automobile traffic within cities, and sensors for security and safety purposes. Okay, and these sensors give customers the sense of flow of traffic, the ability to know if there's people tailgating into areas they're not supposed to be tailgating in. You might see this technology more incorporated into toll roads, heavier municipal cities with higher traffic congestion, and so forth. So, enough of that. Let's get into some financial and quant analysis. Well, not so much the quant, but the general idea of where they are as a company. Price action looks like they went public here. Let me see here. Stock chart says they're going back to October 5th, 2020. Max percentage on their actual price action. A gain percentage, they're down negative 93.92%. They're trading at $5.90 a share. Market cap $285.15 million. This is a penny stock for all in a micro cap company or small cap company, if you will. So something to consider. I've reviewed their earnings. Listened to the conference call, and sounds like the company's CEO and CFO are performing good and coming up with delivered promises. Let's look at gross margin, or let's look at profitability. All right, so they're at 26.5% gross profit margin. Company's management is guiding that they're trying to get up to the 30 to 35% margin, if I recall. Let me see here. So they're trying to get up to that 35% gross margin. This is how I view margins, okay? When we're looking at these companies, if you've been following my channel, you know I'm a sucker for high gross margins in the plus 70% range. If you have a company that serves a product and category or service that has low gross margin, as an investor, when I look at that, you better have a product or service that scales on a whole nother level to compensate for that gross profit margin. Okay. If you're a niche, if you have a low gross profit margin under 50%, and you only have a niche product in a niche TAM or in a limited TAM, I'm probably going to stay away from you as an investor. But Ouster is a little bit different. They have a SaaS and product, a product category with a tech stack combined into an actual opportunity of scalable TAM that should support gross profit. gross profit margin to increase. So they'll have different echelon or different phases of scale within their revenue to where they'll be able to turn levers to increase profit margins, gross profit margins sporadically. According to this conference call, they hit one of those phases or tranches of revenue and revenue growth to give them the ability to expand margin more. So that's good. So with that's good and bad. So it's good that they're demonstrating that the part of their strategy in their margin increases per that actual TAM taken is demonstratable that it's possible within their business strategy. But it's bad in the sense that they just proved it, and then they just hit that layer of threshold of actual revenue to where they're guiding that margin will be flat for a while with limited upside because they have to wait for the next batch of revenue growth and scale in order to increase that margin again. So that's something to consider. All right. Reviewing their 10K. All right. We'll get into the 10K. Let's look at, let's check if their auditing checks out. Here's their auditing letter. And I did the homework prior to doing the video. So, yep, PCAOB, they got audited, and they were audited by this auditing company, which is under the jurisdiction of the PCAOB. So pretty much I can take these numbers to be legit and accurate. All right. And remember, when you're looking at the companies, only these companies in America are only audited on an annualized basis. So you have to look at their 10Ks. Their quarterly numbers are not audited. So your 10Qs are not going to have this auditing frequency. All right, if you will. All right. So now that I got that out of the way, they have a couple different. Let me break down the business model real quick. I'll take a minute to do that. They have LiDAR hardware, which are powered or transitioning to silicon GaN powered microchips, which is outsourced by other companies, but put into their main product distribution that is aligned with their SaaS tech software stack. These silicon chips, I am an investor in that market. I wouldn't be surprised if one of my companies, Navitas, is selling this company those silicon GaN chips. But typically these chips are faster, they're smaller, they're the longer lasting light bulb, more efficient and faster in the microchip technology category. So I mean that's something. Okay, so they should have their end product. I haven't done much research, I'll admit, but from the looks of it, their end product is good because one, they're outsourcing that lead technology in those microchips into their product category, and two, from the looks of the conference call, the product is working and it's good. All right. How do I know that it's working and it's good? Well, this is a market in high interest rates and growth contraction in several different industries, especially within these microchips. But one of the lead indicators is their revenue growth and trajectories. Okay, if we go to earnings estimates and management guidance, they are reaffirming revenue growth year over year for the foreseeable future to be between that 30 to 50% revenue growth. All right. That is very hard to achieve in this market. I'm going to give you more credit if you're doing it. And if you're standing by your guns that this is what it is. Despite analysts looking at their competitors, all right, despite analysts looking at their competitors in these different LiDAR, in this LiDAR industry, a lot of their competitors are slashing their revenue guidances, and these analysts were kind of surprised that this company is reaffirming their guidance. All right. couple reasons. A couple of good things that I'm seeing with this company's business model is their contracts. All right, they have they have the SaaS tech revenue, which is a percentage of a third of their revenue. So a third is the technological software category, and there probably a lot of that money is going to be attributed towards installation costs and labor and delivery and all that stuff. But within the third of that revenue is the actual tech SaaS software that fuels all the hardware and oversees the main product, all right, which is your visual management of traffic and so forth. All right. I know, very, very hard to kind of understand. You have to, if you're in this investment, you probably know what I'm talking about, all right? But they are seeing some of that reoccurring SaaS tech revenue hit the actual, and it's growing. They're seeing that tech SaaS revenue grow, and it's tech SaaS to a point to where they're at the premature phase where they're doing contracting. So these are contracts that are approved and agreed upon, that are non-canceling. So in that perspective, your revenues are going to be more predictable and safe, as the customers have to commit to that. When they get to scale, will they move to a tech SaaS business model, subscription business model, to where people can start turning it on? Probably. I can see that a lot of companies transition to that. And if you're scaling to that amount, Wall Street will they will revalue your company and give you credit for that tech SaaS multiple. So as an investor looking at this, I see potential. We'll go to valuation. So on a price to sales, I see potential on a hybrid business model. If I'm looking at this, there's an opportunity for that tech SaaS nosebleed valuation opportunity potential. Maybe not soon, but later on that'll start kicking in as that tech SaaS revenue starts ticking up with their higher growth rate. All right. In terms of profitability, as far as getting to be a profitable place, analyst consensus estimates don't project until 2027 that they'll have positive EPS. However, this revenue growth is very attractive, and on a forward price to sales metric, probably not priced into the actual equity right now, as you can see with this price contraction here. All right, we'll go to the balance sheet. Balance sheet looks healthy. 67.48 million. Now, this past quarter, I am tracking that. Let me pull this up. Bear with me. All right. Okay. So, all right. One thing. All right. So, line of credit for their debt. They had a line of credit, and it was at about 44 million. 45, but they had 44 million outstanding that they paid off. All right. So they deleted a line of credit of 44 million off their debt this past quarter. They completely nixed the debt. All right. And that debt was in the form, not that it matters now, but that debt was in the form of so far securities, which are pretty much, how do you say, a secured corporate line of credit attached to treasuries that a financial institution would do. A lower, how do I translate that? A secured, lower interest corporate credit card, if you will. Okay. Anyway, the company decided to pay that 44 million, and the reasoning behind that was their strength in their balance sheet. They had enough cash to where they were confident to where, you know what, we could just pay this off. All right, no harm, no foul. So a majority, where's the rest of this debt coming from? Well, I reviewed their 10K. I did not see any outstanding senior mature notes, which are bonds. Most of this is going to be formatted in the form of warrants, lease agreements, and etc. Okay. With the warrants, all right, there are a couple tranches of warrants, or different groups of warrants, two different groups, if you will. One was in agreement with their actual public offering, which they say is an IPO, but in reality, it was a SPAC, or a special purpose acquisition. But for the verbiage of formalized language in 10Ks, they're still going to call it an IPO. Anyway, this warrant, there's a tranche of warrants out there that it's going to expire 5 years from March 11th, 2021 is when the SPAC went active. All right. We go to our options chain. We can go to Oust. Let's type in their ticker. And there you go. March 11th of 2026. Just like I said, there's that batch of warrants, and there's another batch of warrants expiring in 2025, September 29th. All right. I believe these warrants were bought through financial syndicates and different institutions. And what's the translation to that? What does that mean? Well, that means that there's a ceiling of selling pressure once it gets to a certain threshold. They got it at 115 a share on one of these big warrants. So as you can see, the stock is $5.90 a share. If an investor is buying this equity right now and the warrants are exercisable, the investor probably wouldn't even care because they'd be so rich, because they've multi-bagged in an exponential manner, if you will. I expect these warrants to all expire worthless, though, with the trajectory, price action, and so forth. Could we get a euphoric market where this thing runs back up to, say, in the hundreds of dollars? Yeah, anything's possible, but unlikely, with the actual macro and the interest rate lags and the Fed just barely cutting rates now. That's a couple years away. I think it's going to take a while for this business model to catch that tailwind of crazy exponential gains. All right. So now that I got out of their balance sheet, let's look at the actual. Let me give you the actual product names here. So their software solutions, which is part of their tech stack, is Gemini and Blue City. All right. So Blue City is let me maximize this a little bit. So Blue City is the software technology that manages traffic, the trafficking system in cities and such. All right. So that's one segment. Your Gemini is the cloud-backed tech stack that is aligned with the LiDAR platform, and that pretty much gathers information on growing the technology and the synergies between the hardware and the software. And this is how I understand it. All right. So that's something to consider. Here's your CEO, Angus Pacala. It will go to their management team. There he is with a suit on, and Mark Weinswig is their CFO, according to this and information that I've gathered from the conference call. I think the management is pretty confident, and they're pretty much, man, they're the resignation, or not the resignation, they're the residual. I perceive them to be the typical Silicon Valley entrepreneurs of today that are building ponies or what have you. Or how do you say? Yeah, $1 billion companies. Okay, so that's something to consider. They're young. The management team is young, so typically with these startups, you're going to have growth-oriented management teams and founder-led to scale the growth. All right. So going on to their options chain, it's a mixed bag. Probably because this is an infant company, there's not much interest going on. Most of these contracts might be a little bit, or a lot of it might be retail, but mixed bag on the puts and calls. So not even worth analyzing. It's all over the place. Maybe in another company I'll explain it more in depth, but this was a pretty long video. Moving on to insider selling and buying. The majority of insiders, there's a bunch that are being bought. Okay, I'm seeing more shares being bought than sold. Okay, and it's a mixed bag between different officers and different executives, if you will. All right, and they're buying at the $7 range, shy of the $8 range. So pretty some indications that the executives think that this stock is undervalued. All right. I will admit I've looked at a lot of competitors in this category and compared them. I think that this is probably the winner, not financial advice. And once again, I don't hold a position in this company, but it is a very interesting company. I think that it's going to take a while for them to scale. Well, not scale into profitability. All right. So these targets are probably accurate from what I'm seeing with their storyline. What's impressive to me is their actual growth is sustainable and predictable, and they're standing by their guns that they're saying, yes, in this crazy market where growth is slashed across several categories, this company manages to keep their projected growth rates up and stand by their guns to say, nope, we're still going to grow these rates. So we'll go to earnings. We'll go to earnings summary. They have said that they've hit their own, they've surpassed their own and then beat their own guidance on revenue for the past 6 quarters. So that's an indication that Wall Street and analysts are kind of maybe not on board and don't understand the modeling of price targeting and such, or revenue and EPS targets, because analysts have a different picture of the company as averse to the actual management team. If you're a savvy enough investor, you may be able to capitalize off that arbitrage value disconnect between the analysts and the management team. Okay, so something to consider. I know it was a lot to take in, but this is my video on Ouster, the overview that I'm seeing. What do I think in general with this investment? I think if you're buying into this company, there's probably more downside to come because they have to prove more of the business model to scale on the next tranche of gross profit margin expansion and level of scale. And they have to have more clarity on their actual earnings, on the different segments of their revenue framework and customer base, because they don't go into too much details about the customer. So it's going to be hard for these analysts to come up with pricing models to secure a higher valuation on Ouster for this company to get respect on Wall Street. But that's typical with this infancy of a company. I think investors coming in here are a little bit early. I could see a little more contraction happening, not too much, but from a price perspective, I can see this thing going into high $4 range to low $5 range. Okay. Well, that's my take on the company. I hope you got value. Be sure to subscribe and like the video for more content. Check out my Patreon if you want to be in a community of like-minded investors and you want to get more in-depth instructionals and access to my hidden gem collection, buy and sell alerts, comprehensive different products that are included in the Patreon, the cheap Patreon membership, which I have a lot of plans for my Patreon. So that's something to consider. Take a look at that. But with that being said, thank you for your time and enjoy the rest of your weekend.